All right, good morning, everybody, and thank you so much for joining me today for Coffee with FourThought, our June edition. Excited to have you here. Giving it just a second for everybody to join us. As a quick reminder before we get started, we are doing a live Q&A like we always do after our session today. So if you have a question for us, at the very bottom of your screen, you should have a nice little Q&A box. Feel free to type it in there. We try to get to as many as we can. If we can't get to yours, one of our team will definitely follow up. We want to make sure we get those questions answered. So please make this as interactive as possible. We love getting those questions, seeing what's on your mind. So just keep that in mind as we get going. As always, I'm Joel Johnson. I am the Director of Planning here with FourThought, but I'm actually joined today by a special guest, one of our planners here. His name is James Stamper. Jake is taking some much-deserved time off. So James, welcome. Thanks for joining me today.
Thank you, Joe. Glad to be with you.
All right, and you might notice a slightly different layout today, so we'd love your feedback on that as well. Much more personal for you and I to get to talk through some of these key items that we want to make sure we touch on today. So why don't you kind of walk the folks through what it is we're going to be talking about today?
Yeah, we've got a jam-packed agenda today. We're going to be talking first about the markets and what has been a really resilient first half of the year. Lots of activity going on. So we're going to talk about the year-to-date market updates. SpaceX, it's in the news. I don't know if there's a name that is on the front of most people's tongues more than SpaceX today. So we're going to really dive into the IPO and cover really what's going on with a very popular company. Mm-hmm. We're going to look at earnings. We had a lot of earnings, important earnings that came out, and we're going to kind of give a report card on how that looks. And then finally, we're going to look at the month of May in particular that we just wrapped up with some interesting data. And as always, we're going to try to put our spin on what's happening in the markets today.
Sure.
So,
great. All right. Well, with that intro, let's go ahead and dive right into it. Let's start with what we saw last month, which was another great month for the markets. Slightly rocky start to the year, of course, but we're kind of seeing a resurgence. And when you look at the slide that we have up for everybody right now, stocks continue to soar. I mean, U.S. stocks were the leader for the month, up a little over 5%. Not far behind them, of course, we had the global stock market, which is still holding up extremely well. It was really just a kind of all rising tides raises all boats for the month of May, which was fantastic to see. It certainly helped our accounts. When you look at the regions snapshot down there at the bottom, we've got emerging up almost 10% for the month, which I think, given all of the geopolitical tensions that are currently out there, news coming out every single day, somebody sneezes in the wrong direction and you're getting markets going. I think what we're seeing on the talking heads on TV versus what is actually happening in the markets, I'm seeing a pretty big dichotomy there between those two things. I don't know if you'd agree with that.
Yeah, I would agree. I mean, of course, the Straits of Hormuz being closed were really the big news. And as the market started to stomach what that really means, we saw obviously oil prices being the really big spike, yeah. Right? Mm-hmm. Not sure if we've completely felt the impact of the inflation of that yet as it hit businesses and consumers. We may see some of that, but what the big news was obviously was what does oil prices mean to the greater economy? As soon as we started seeing some type of halting to active hostilities between Iran, the United States, and Israel, you saw the market recover pretty quickly. So all signs are there that the consumer is healthy, the market's pretty healthy, assuming these big disruptions.
Right, absolutely. Yeah, and it was a big resurgence for growth, of course, led the month. Again, start of the year was a little jittery for the growth side of the market, but it's definitely picked up. And I think what they've done so far on the growth side of the market is really shrugged that off. I agree. We do have to keep an eye on what's happening with inflation. We'll talk about some more economic data points coming up here. But for the time being, the market's just kind of saying, okay, we'll deal with it as it comes, and what come will, and growth is going to continue to rip.
Yeah, as we've seen in the past, these geopolitical risks, these other types of shocks that would normally, you would say, would have a longer lasting and a deeper impact on the market shrugs it off, yeah, and continues forward. And that's not only U.S. but global.
Yeah, absolutely. And so let's kind of pan out a little bit, and let's flip over to year to date and what we've seen year to date as far as the markets go.
Sure.
Again, international continues to lead. Now, the value side of the market is actually doing a little bit better this year, which is good to see. Growth, especially in 2024 and 2025, was the absolute killer. It destroyed value on a relative basis, but value's starting to come back a little bit. So the breadth in the market, we think, is starting to expand at least just a little bit. Small cap Small cap also starting to do a lot better finally, right?
Yeah, waking up a little bit there.
Thank goodness.
Yeah.
One of the things we always preach, and we preach during these presentations too, is diversification. And we're seeing that play out really well. Emerging markets, international markets continue to be the outperformers. They were last year. They continue into this year. Small cap making that change. So talk to me a little bit about what you're seeing in client portfolios right now and what we're talking to clients about as far as making sure that we're getting away from large cap growth specifically, not totally, but specifically just to take advantage of some of these rotations we've been seeing.
Yeah, it's a good point, Joe. I mean, the mega caps have dominated the news, and for good reason. I mean, we are in the midst of arguably this huge AI data build out. This infrastructure it's in the news every day, but it shines a light on the importance of staying diversified, especially across asset classes. Because to your point, small cap has been sleepy for a while, maybe underperforming, and now all of a sudden it's kind of waking up. And it's waking up under an environment where we may have not predicted it would. Typically, small caps need a little bit lower interest rates. We haven't seen that, but yet we see companies that are being tapped on the shoulder because maybe their product or their service is duly needed now with this data center build out, for example, and you see companies just go to the moon.
Yeah.
And you're seeing that in the small cap space.
Absolutely. Yeah. And speaking of to the moon, I did a little bit more research on kind of what's made up the year-to-date returns. And if we focus on the S&P 500 specifically, so getting a little away from what we've got on the screen there for folks, year-to-date, the S&P through the month of May was up almost 12%. Let's call it 11. It was up 11.7%. Okay. Of that 11.7%, 5 companies, only 5 of the 500, made up 40% of that return.
Wow.
Yeah. The other 60% of that 12% or so was 495 companies. So being diversified, because those 5 companies, I would argue, were ones that most folks probably didn't anticipate. It definitely was not the FANG names, those mega caps. That's not what's driven performance. So staying diversified would have at least had you participate in those names and their meteoric rise that we've seen year to date.
Yeah, good point. Absolutely. Yeah.
So switching gears real quick, you mentioned interest rates, especially for small caps. So lead us right into that. So tell us kind of a little bit on the rate side.
So as it says on the slide there, yields are on the move, but not in the way that I think most analysts would have predicted, say, going back a year ago. We were thinking we've seen inflation under control. We've seen energy costs come down. We had an administration that was not quiet about the fact that they would prefer lower interest rates, and we see a Fed chairman that is on his way out and a new Fed chairman coming in. So with that backdrop, a lot of analysts, rightfully so, are saying, hey, we can anticipate lower interest rates by the second half of 2026. Mm-hmm. Here we are, and yields are on the rise. And, of course, that's short-term could be because of, obviously, the whole Iran war issue, but as we take a step back, the market, in particular the bond market and bond yields, are wanting to go higher. The yield curve that was inverted forever is now right-sided, and we're seeing, even in the 20-year, which is not on the slide but something to keep an eye on, we crossed a threshold of above 5% for the first time since 1999. Yep. So rates are wanting to go higher. It's something to keep an eye on, of course, but again, it goes to our theme of forecasting but not predicting and not making big wagers either way when it comes to interest rates.
Mm-hmm. One of my favorite sayings when it comes to the markets is don't fight the Fed. We can't control them.
Sure.
And I think at this point, the Fed kind of has to keep that in mind. They can't fight themselves. I think the new chairman coming in is in a sticky situation. We've been talking about this. You kind of alluded to it, which is the economy's doing pretty good. Again, I think feelings about it are much different than what the data is telling us. He's been coming in and he's been an avid proponent of cutting interest rates. Mm-hmm. I don't know if he's going to have the room to. I think at best what he's probably going to be able to do, at least over the next couple of months, is keep rates steady. So a couple of folks have been looking for rate hikes. I don't think that's in the cards. I agree with you. I think rate cuts are definitely a much lower probability than they were. So we might be moving into more of a normalized interest rate environment where it would take a significant geopolitical shock or something in the economy to kind of force them to make a move. But right now it looks like we might have normalized, and you mentioned the yield curve normalizing too. So rates do want to go higher. We've seen them go higher, but as long as we don't see jumps, I think people are going to be able to adapt.
I agree. I mean, I agree on your comments. The new Fed chairman come in has to manage the situation as it is in front of them with the tools they have.
Yeah.
And long term they want lower interest rates, but for now has to manage through what we're seeing.
Yeah. So keeping with interest rates, the one that I think most people are affected by, of course, is the 30-year that we have on there, which is a good segue into our economic indicators that we like to take a look at, that holy grail that we always have. Housing is an interesting place to start here. So if we are in a normalized interest rate environment, folks have been calling for mortgage rates to come down. That doesn't look like it's going to be the case anytime soon. So is the housing market going to stutter, or is it going to start improving? And I think we're kind of moving towards the probably going to be improving. If you look at the numbers that we have here, the housing starts is actually up pretty significantly over the last 3 months, almost 10% over the last 3-month increase in housing starts. Anecdotally, you just saw Berkshire Hathaway make one of their largest acquisitions ever by buying Taylor Morrison Homes. So they are definitely on the housing is still a long-term American dream. People are going to continue to buy homes. And I don't think at this point interest rates are going to be stopping folks.
I agree with you. And I also believe, too, that, and this could be anecdotal as well, but I was recently talking to a young couple that were looking to buy their first home, and they were looking at a new build. And the builder had come up with a creative way of, instead of incentivizing, say, nice cabinets or $100,000 of upgrades for the home, they actually took a lot of credits and put it towards buying down the interest rate on the mortgage. And I think keeping that barrier of entry from, say, 6.5, where I think mortgage rates are right now on a 30-year, to maybe getting them sub 6, even into the mid 5s, that helps that young couple, get that home, and they're a little bit less worried about maybe some of the finer upgrades. So I think they're getting creative in that capacity as well. So you're seeing, housing starts up.
Tough one for you. Do you think that's a conversation that somebody should have with their financial planner when they're making that decision?
Oh gosh, yes. You know what? I think listen, it's an exciting time when you're buying your first home, and you're totally in that heart space. Hiring someone to come over to the mind and say, hey, let's look at this logically and see if we could forego some of those lovely upgrades to lock in a monthly payment that fits our budget. I mean, that's the prudent thing to do when you're looking at hiring a financial planner. So, yeah, good point.
Yeah, great. So jumping down a couple of other ones here. Of course, oil. You mentioned it earlier, how that's going to relate to inflation. We haven't seen it quite yet. It's starting to tick up. It's actually kind of been bouncing in this $90-ish per barrel area, which not great. I know I'm still feeling it at the pumps. I think everybody is. But again, as long as you don't see any shocks one way or the other, especially to the high side, we're going to be able to work this into the economy, I think. But again, it's all going to come down to what this does to inflation and the consumer.
I would agree, and I said, as I mentioned in my opening comments, I'm not sure that we've fully seen the inflationary impact of these oil prices, because it is the lifeblood of the global economy. As much as we would like to maybe get away from some, oil still is king. And for that reason, to see prices spike first, and you see that at the pump, I don't know that we've seen that permeate its way through the economy. Hopefully, there's a resolution, the straits can be opened, and we can get back to normalcy as far as oil supply, so those impacts are less felt, but I think they're coming.
And you and I were talking a little before this about kind of the labor market and what we've been seeing there. What we're actually showing right now is unemployment is steady, actually dropped a little bit from 3 months ago, which is good to see. But tell me what you're seeing and kind of your thoughts on the employment picture right now.
Yeah, it's a tough one because we have AI amplifying human output and doing that really efficiently. So you're seeing that carry on to the bottom line and the margins and the reporting and earnings, which we'll get to a little bit later. But I don't know that quietly there's almost like a hiring freeze in some ways. Companies aren't aggressively expanding. So if you're coming right out of college, your opinion of the economy and the way you feel it may be a little bit different than if you're gainfully employed today. So it is an interesting space that we're in right now, where hiring is not as aggressive as we might see in a healthy economy, but the layoffs aren't there as well. Companies are doing more with the same or equal amount of labor.
Yeah, I think the anecdotal layoffs that we have seen have all been in the space we would expect, which is software.
Yes.
Pretty much only in software. You're not seeing it at Walmarts and such yet. If we do hit some sort of economic turbulence, you'll start seeing it there. It'll start permeating. Ironically enough, these coders and these software engineers have kind of engineered their way out of a job. One of the interesting things that I've heard people in that space talking about is that, like you said, it's really more of a hiring freeze, and all the layoffs that we're seeing is because of the glut that we had from COVID.
Correct. Yeah.
And I tend to agree with that sentiment. And what I'm hoping that kind of the positive side of AI is that these folks that have all of this knowledge and skill, especially in this space that is ever expanding, they're going to be able to go out, and because they're able to do with more, we actually expand the economy rather than worrying about them jumping from Facebook to Google or wherever that might be. Mm-hmm. So it's going to be interesting to see. And again, the one that I'm watching is how that permeates to other parts of the economy. But as long as it's contained, it'll hurt the sector. But
yeah, and another thing that's kind of quietly maybe under the surface but is bubbling up is it's never been easier to be an entrepreneur today.
Yeah. Mm-hmm.
With the tools and resources available to come up with an idea and to be able to see that idea through, hiring the tools that are available today for as little as $20 a month subscription, it's amazing. So, that entrepreneurial spirit, and of course not everyone's built to be an entrepreneur, of course, but it's never been easier. And so that's exciting. At the same time, like we said, I think there's a quiet kind of hiring freeze out there in corporate America as they figure out how to integrate these tools into their existing businesses.
Yeah, great. All right, so talking about freezing, how's that for a segue? Let's jump over to SpaceX and let's talk about the big thing that's on everybody's mind. I'm getting calls about it. I'm sure you're getting calls about it. SpaceX is IPOing in the month of June. It's very exciting, but let's talk about what's actually happening here and kind of what's behind the headlines.
Yeah, happy to do it. And I'll start with a little story myself. My first experience with SpaceX was nearly 10 years ago. Me and my wife took a trip over to Cape Canaveral, and we were able to take a tour and see the legacy of NASA there and the involvement with us putting a man on the moon. And it's just, to be there in person and see the size and the scope of the engineering, it's just impressive, right? Mm-hmm. And we hired a little tour guy to give us a tour of the place. And we were in a van, and we're actually driving past one of the big movers that used to move the space shuttle for launching. You just get an understanding of how large and
the scope of it.
It's just it's the edge of human engineering. And then at the very end of the runway there was SpaceX, and this was again 10 years ago. And the gentleman who was giving us the tour was like, "Yeah, they're super busy over there. They're really the only thing that's happening over here." Fast forward today. Yes, SpaceX is 24 years old. It was actually in 2002 when Elon created the company. A very bold, audacious. We're gonna make space exploration, space travel cheap, and we're gonna make it easy for humanity to spread to other planets. Mm-hmm. That bold mission statement has really made it easier for him to attract some of the top talent there. So there's some brilliant engineers that have gone to work at SpaceX, and they haven't waited. They've been quick, and they've failed many times and learned from those failures. So they're at a point here where they've been able to identify where the friction lies in making space travel cheap, and that is the launching and recovering of space vehicles. So that's led to all of these, this big, bold mission statement, let's go to the moon. All these use causes that have come along have actually built a very nice business. Yeah. Now, the evaluation is through the roof, as we've talked about, and the excitement is really on the future earnings and the capability of Elon and his team to bring this into where they are launching just an amazing amount of almost daily, similar to like what we're seeing in our domestic airlines. That's where they want to get to is space travel, which is just amazing. If those costs come down, some of the realities of these evaluations maybe start to take shape.
Sure.
But it's going to launch, I think, June 12th, June 13th, if I'm not mistaken. And right now, 61% of the revenue is Starlink.
Right. Mm-hmm.
And the idea of being able to provide high bandwidth internet to the globe is a reality.
Yeah.
At one point, I think they were signing up 20,000 new users a day, which is just phenomenal. So that is really the revenue.
That's the revenue driver.
That's the revenue. Now, there's something called Star Shield, which is quite a bit. There's not much in the media about it because this is a government relationship. It is classified, but it's launching government satellites, of course, and so there's some government contracts there. So those two are probably the big revenue producers now. The future is the ability to continue to launch payload in space, and that's in. And right now, I believe Starlink is about 75% of the world's global launching of payload in space, primarily satellites and other items. But as we start to think about the moon being an actual place where we're putting a base on the moon,
crazy to think
about. But there's something underlying too that I think is exciting people, and that is the reality is that the AI that we're dealing with today is hitting up against power and compute restraints. And Elon has been public about the fact that he has found it challenging to be able to expand and meet the demand as quickly on the energy side.
Yeah.
Dealing with municipalities and utilities are not something that move fast. So, as crazy as it may sound, we may be looking at data centers in space in the near future.
Right.
And he's got obviously the vehicle to do it. So that's a lot to unpack, but it's exciting because there's a lot under the surface here to be excited about for this IPO.
Yeah, so diving into the numbers a little bit more on it. So a lot of really great ideas. I mean, exciting vision for what this could become. But when this does come public, it's going to be at about a $2 trillion valuation right off the bat, which puts it up there with the top companies in the world as an IPO. Crazy to think about. You've got, like you said, Starlink is really the revenue and earnings driver right now. That's where they're making most of their money. In 2025, they still reported a loss of $4.6 billion, as expected.
Yeah.
These are not cheap to get up in space. Even when you catch them with the little toothpicks on the way back down, it's still extremely expensive to get these up.
Yeah.
So the vision is there. But what we're asking you to do is really pay forward for all of those potential earnings that we still have no idea what that's going to look like. So the vision is there. The vision is exciting. A lot of people are hanging their hat on what happened with Tesla over all those years. That's been a fantastic investment. Mm-hmm. What we always want to caution investors about, though, is what it takes to get there.
Yeah.
And Tesla especially. It was a great company. Same thing. Great vision. People were excited about it. The volatility that you saw in that name over the years, looking back, you're like, oh, I knew that the whole time. It was going to be a great company. I didn't worry. I didn't panic. The number of times that company got cut in half.
Nope, yeah.
You know what I mean? And so we worry about that with clients, especially when they're looking at things like this. We are fundamental investors at heart. That being said, we like the vision. This is definitely something that's going to be on my watch list, but with the valuations they're asking for today, I think it's a little stretched in my personal opinion. We'll see what the market thinks. The other thing I want to point out, which is interesting with SpaceX, is the voting rights.
Right.
So you've seen this with a lot of tech companies previously. Facebook did it, Google did it. And essentially what used to happen in the stock market was they would come public. You and I as investors would have some say over how that company's run. And what these companies are doing now is saying, I don't want your opinion. I'll let you participate in the potential benefits of all of this that I'm producing, but I'm going to be running this company. Mm-hmm. And this is probably the most aggressive that I've seen in that space, where Elon's going to still end up with 85, if I got that number correct, % of the voting shares of SpaceX.
Yep.
So you are really hanging your hat.
You're really investing in his vision.
Exactly right.
Yeah.
Exactly right. Now, again, good and bad parts to that. It's different than what the stock market has normally been used for. It's something to be aware of. And just go in eyes wide open.
I agree, and I think on the screen there we've got some other things to be concerned about, and I think we've even got a little bit on the next slide to talk about how the functionality of an IPO, because there are some traps, if you will, and one of them in particular is there a period of time, because keep in mind this has been a private company for 24 years,
yeah.
And there's a lot of early investors that are sitting on huge gains.
Yeah.
And they are restricted once the IPO launches to be able to take profit for a period of time. And then when that period of time, normally it's 90 to maybe 180 days, once that frees up, you do see a lot of pressure potentially on the stock price because of all those shares now being able to be sold.
Yeah.
And so that's something to keep in mind if you are if you were blessed to be an investor on the private side, great. You're all in, obviously. But if you're excited about it and you're starting to want to deploy capital, just be cautious.
Yeah. Yeah. Great segue into let's actually talk about what an IPO is and how it works. Because I agree. I do think there are quite a few misconceptions about it that people get trapped into when we start talking about those. And we've got other ones coming up that I'm sure we'll be hearing about and clients asking about. So let's kind of get ahead of that a little bit with, Anthropic, all of these AI companies. You've got OpenAI probably going to come out later this year. So kind of walk us through a little bit. How does an actual IPO work? What are clients getting when it hits the NASDAQ? What does that function look like?
Yeah, and I think this goes back to the trend of what we've been seeing. If just to use an example, Joel, in the past, if you and I came up with a great idea in our garage and we wanted to, take a company, we might need to have capital raised in the private markets for a period of time, but our real opportunity is in the public market. So the rush would be to let's get public as quickly as possible.
Yeah.
What you're seeing now, and it goes to the size of the IPOs when they launch, is you're seeing companies stay private for 10, 15, in this case 24 years. But by the time they go public, they are a well-established company.
Right. Mm-hmm.
So the company files an S-1 filing. That's what people have gotten pretty excited about because that is a prospectus. It really talks about where the company is. For the first time, the public's really getting more of a little bit of a vision. The details.
That's where we find out that SpaceX's revenue is primarily Starlink.
Exactly.
Got it. Okay.
Exactly. And then as you see on your screen there's there'll be an underwriter. I think in SpaceX's example, I think it's Goldman Sachs is the primary underwriter of this, and they get this ready to go public and ready to actually have a ticker symbol and folks to be able to buy the
roadshow.
Yep. Mm-hmm. And then of course they're out there, and the period of time before this happens, and you may have seen this in the news because Elon is in the news quite often. They're pretty quiet about this. They have to be for obvious reasons. They can't speak to the details of what's happening in the company. So prior to that, they can talk, but they start to have this little period where they're really quiet about these things. Mm-hmm. And then of course pricing comes out, and then it's listing, and then it's actually able to trade, and you're actually able to buy the stock. Anything you can add to that would be great.
The biggest misconception I see with folks is that pricing portion.
Exactly.
So a lot of people see the $1.75 to $2 trillion valuation and they say, I want in on that. When it starts trading, you don't have access to that. That's already been locked in, and that is for the institutional investors, the roadshow portion. Those are the folks that are getting, when this comes out, I'm sure we're going to see 100% up on IPO day.
Of course.
Something like that, some crazy number. You and I as retail investors don't have that opportunity, right? And so that when I talk to clients about IPOs, that's the biggest misconception I see. Doesn't mean we shouldn't buy it if you really want to. It's just if you're expecting to get that first day pop, sorry, you don't have access to it.
Sure, that's a good point. Yeah, I would agree with that, and I think also too the excitement. There's nothing more powerful than going to a SpaceX launch. If you've never been to one, they're amazing to see, or for that matter, a NASA launch. They're just awesome. So I think this has been a very visual company it's been in the zeitgeist for a while. So the retail investor is excited. We just caution pouring into something in the IPO stage when you could potentially maybe get the stock at a price point that maybe is a little bit better for you or more appropriate.
Yeah, families used to go for rocket launches, and for the first time ever, now we can go to rocket catches. That's going to be fun.
Yeah.
New vacation to add to the list.
That's a good point.
Anything else on IPOs, or should we switch gears to earnings?
Let's look at earnings.
All right, let's do it. So we are almost through quarter one earnings. Jake and the team on the research side have been hard at work. We are about 90-ish% done with the S&P 500 companies have reported. It has been what I can only call a blowout earnings season. I mean, the anticipation for what we were going to see and the reality have just not matched, in my personal opinion. We were expecting a good quarter, but not what we've gotten. So the numbers up on your screen right now, you've got 87% of the companies that have reported beat their analyst estimates. So the guys that day in and day out, all they're trying to do is look at these companies and guess what those 3 months are going to look like. 87% of them undershot what was actually reported. The average beat was almost 42%.
Amazing.
And if I look at the numbers, I believe it's about 16% actual earnings growth in the S&P overall, which is just incredible. So we touched on it a little bit already. People are doing more with less. More is dropping to the bottom line. That's what's helping to fuel this increase in the stock market that we've seen. So anything to add to this and just kind of looking at that scorecard?
Yeah, I mean, I to your point, in the past, if you take a large corporation, maybe they hired an outside consultant to come in and really get to learn the company over the years, and come up with ideas, ways to move the needle a percent or two in efficiencies. Being able to give an entire 30, 40, 100,000 employees access to a tool that helps them do their job better each day is an exponential within that company, right? And so the cost of that is so small relative to how much that can potentially move the margins and the efficiencies within the company. I think you're seeing them. It's not all AI, but it certainly is a big component of it, right? And so again, as I spoke to before, I mean, the magnifying my ability, your ability, our ability to do what we do best by utilizing AI. It's amazing. And you're seeing that across the entire globe.
Yeah.
You've never seen a faster adoption than OpenAI and Anthropic. And so, as these tools also are just getting exponentially better. We're talking about something that we've only really been dealing with since 2022. And you saw a new version launch maybe every year. Those launches then became every 6 months. And now we just had Opus 4.8 come out last week.
1 month after 4.7.
Yeah, like 4 weeks, 5 weeks after 4.7. At what point do we get to a point where we're having weekly and then daily launches? So this exponentiality of that is also helping with capabilities. So I think that's hitting the bottom lines of companies. And so we're in this era where we could see, and this is not a prediction, but we could just see this continued efficiency, thereby profitability to the bottom line of companies.
Yeah, and so that's one of the reasons we actually look at these earnings calls and go through these reports is, yes, this was all the past, right? We're just reporting what has actually already happened. One of the nice things is you also get to hear from management about moving forward, and that's where you would hear about these efficiencies, how they're integrating AI.
Yeah. And I would say, I don't know if they all got together. I'm not saying they did, but most of these guys and gals are very muted in their predictions. They're understating, and then the market tends to trade off of that. So, trying to square that in your head of saying how can a company like NVIDIA just have blowout earnings, just like they continue to do every year. Every quarter over quarter, they just continue to hit home run, but the stock sells off. Yeah, and it is because they're very cautious in their future predictions, and I think the market trades off that a little bit. Historically, that's been an opportunity. Yeah, absolutely. Yeah, so let's actually talk about NVIDIA specifically. So they did report last month. Yep. It was exactly what you just said. So they set expectations for the market. The market said, we don't believe you. And so we're going to do what we typically call price it to perfection. You've got to hit all of these numbers top to bottom line. And if you don't beat those high expectations, we're going to sell off the stock, even though you've seen numbers like what we've got up on the screen right now. So you had earnings per share of about $1.87. Revenue in the quarter was $82 billion for NVIDIA. The data centers continue to grow. You've seen their chips. You can't get enough of them. They can't build them fast enough for people to use. That's not going to stop anytime soon. All of that, all of these great numbers, the stock down 2% the day after that reporting. Exactly. Yeah.
What happened?
Yeah. Well, it did everything it said it was going to do and some. And I think it's kind of the buy the rumor, sell the fact, right? It's something that you're seeing as soon as earnings come out. The company does everything they say they're going to do and more. As much as Jensen Huang gets on stage and talks about the next evolution, because we've talked about Blackwell, which you've got on the screen there, is just completely high demand. Vera Rubin is the next version of there, and they're already backlogged on those orders. So it just looks like the future looks bright. But you're not going to have a CEO, CFO get on a call and be very aggressive about stating the reality of where things are. So I think the build up, the confirmation, you see the stock move, and then the stock sells off. I'm not sure if that's going to continue, but it does seem to be the trend.
Yeah. Yeah, and at the end of the day, again, we are fundamental investors at heart, and so these earnings do matter.
They do.
We are okay paying for growth as long as we see that growth. They continue to invest heavily in the AI build-out, which is coming along with all of this CapEx spend that we've been talking over the last few months. We're going to keep a close eye on them to make sure that we're seeing the returns from that CapEx, and if we don't, that's where these expectations are a little bit ahead of themselves, and the 1% to 2% move could turn into 20% to 30% moves. So that is a possibility, not one we're predicting, but it's something we're keeping an eye on.
Yeah, and I think everyone sees the margins in NVIDIA's business, and I think Jensen has done a great job of recognizing that anytime there's someone with the growth and the revenue and the demand that NVIDIA has, there'll try to be competition coming into that space. And we're anticipating that as well, and we're keeping an eye on those companies. But so far, they are really the 1,000-pound gorilla.
Yeah, absolutely.
So
talking about 1,000-pound gorillas, Home Depot.
Home Depot, yeah. Talking about hardware.
Complete flip side of what we saw with NVIDIA. So NVIDIA, price to perfection, high growth company, significant margins, a lot of CapEx going on. Home Depot, Steady Eddie, the big orange. Talk to me about what they reported and kind of how they're looking.
Yeah, a good point. And on the screen there, a little bit about their numbers. But if you kind of look at Home Depot as a measurement of the overall economy, they're typically a pretty good barometer. And for them, they're a consistent dividend producer. That's one of the reasons we've had them in our model for years. Great company overall, and I don't have the numbers in front of me.
That's right. So you're getting a much better valuation with Home Depot, right? So from a fundamental standpoint, again, it's not going to be doing 30, 40% revenue growth. You're not expecting that from Home Depot. What we're looking for is just continue to pay that dividend, continue to grow that dividend, and benefit from this great U.S. economy that we're seeing and all the spending that the consumer's going through. One of the great things, I think, is this also ties back into our conversation with housing. If housing continues the direction that it looks like it's going, they're a big benefactor of that.
I would agree. If housing starts continue, Home Depot will ride that. Yeah, for sure.
Now, you did see margins narrow in their case, which is okay in the short term. We like to look at that over a full cycle because you're going to have these things kind of in flux over time, especially with weather events and all these crazy things that we can always point to. But as long as they stay in a general range, we're comfortable with that. You've seen share buybacks. Share buybacks have that's a really good way. It's not a direct dividend to you and I as shareholders, but it's a really good way for them to improve the value of our holdings over time. And so it's one of the things that we looked at. Now, they did pause it because they wanted to prioritize what they're doing internally, which is fine. Again, as long as you're using those dollars, it's a capital allocation decision. Go for it. We trust you as a management company. But these are just some of the things that we like to look at. And again, great company, good valuation. You're not going to be knocking the barn doors off of anything, but over the long term, it's going to be a really good performer.
Yeah, and to your point, stock buybacks are typically a bullish sign.
Yeah.
Typically. But us looking under the hood, that's what we do with all of our companies to make sure that, to your point, the valuation today is justified by the books.
Right. Yep, valuations matter at the end of the day. If it's a
do.
growth company or if it's Home Depot.
Absolutely.
Well, good. Well, that's all we had as far as our slides go for today. Thank you, everybody, for joining us. Thank you, James, for being here and doing this with me.
Glad to be here with you. This was fun.
It was. I like this face-to-face.
Yeah, it's a new format. It takes a little bit to get used to, but I enjoyed it.
We'll get there. So we're going to flip on over to our question and answer session now. Hopefully you folks have put some good ones in there. As always, if you know anybody who would benefit from hearing this conversation, being able to ask their own questions, please feel free to have them reach out to us or send us their information, and we'll get them on our list to make sure that they can join us for next month. And with that, let's jump on over to the Q&A.